Okay. Good afternoon, everyone, and welcome to the second edition of our webinar series. Thank you for making our time to be a part of today's event. And as promised during the last call, we are going to be here to provide guidance and clarity as to how to better manage your investments, refine your strategies, and help your portfolio yield alpha. Going into today's call, for first quarter and even till now, if you were not seated with your seatbelt fastened, the volatile swing of the market would have hit you or even knocked you down already if your portfolios are not already down. And some popular memes that we saw first quarter and even till now, stories like buying the dip. You know, when will this dip stop dipping and how deep will the dip go? Here in this webinar, we're going to be discussing all of that and more. And because we noticed that people have been, overly focused on traditional asset classes, believing that all of the benefit that possible can only come from there, not knowing that there is more to it with alternatives. So that's why our focus on this webinar is on the alternative investment strategy for navigating the macroeconomic difficulty that we currently see in the present economic condition. My name is Victoria Injimanze. I'm fund analyst here at Afrinvest Asset Management, and I'll be your moderator for this edition. And with me, we have Robert Omotunde, who is the Chief Investment Officer at Afrinvest Asset Management. We also have Folari Adedeji. He is the Portfolio Manager here at Afrinvest, and Timitope Omosui, who is the Investment Strategist Analyst here at Afrinvest Asset Management Limited. So I'll be opening the floor to Robert Omotunde, who is going to just give us a quick opening speech before Timitope gives us a macro and market outlook for this event. Thank you. Robert, over to you, please.
Thank you very much, Victoria, for the introduction. And thank you everyone for joining this webinar once again. This is our second in the series, which we've tagged the Q2 edition. And this time around, like Victoria said, we have decided to go against the traditional asset classes by featuring alternative strategy. That is, we are looking at alternative strategy that you can employ or using an alternative strategy as an asset class as against just talking through the traditional asset class. And that's why we titled this alternative strategy in periods of uncertainty. We're going to go into the presentation and quickly take you through all of the points that we earmarked for this particular presentation. We have just 5 segments to go through. The first one is the global and domestic macroeconomic performance, after which we talk about the market and macro outlook. These 2 sections will be taken by Timitope Omosui, who is our investment strategy person in-house. Then we have the next 2 sections that speaks to alternative strategy in periods of uncertainty, which is our theme for this particular edition. And of course, the investment strategy that we should be looking at for Q2 2021. My humble self will take you through those 2 sections. And then the last segment will be taken by Folari Adedeji, who is our portfolio manager in-house. It will take you through our products and services and how you can actually action the theme of our webinar this particular month. And of course, your questions and answers are welcome. You can type them in the chat board, and Victoria, your host, will make sure that we are aware of those questions for us to provide answers to them. So Matthew, please, over to you.
All right, thank you. Good afternoon, everyone. I'm Omoshi Timitope, and I'll be taking us through the global and domestic macro and market performance for the first quarter of the year, as well as the outlook for the rest of the year. We all know that the condition of COVID-19 and even the vaccination are very important to the speed of economic recovery. So we are starting on that note. As at April 30th, we note that COVID-19 infection has risen to about 251 million, just about 80% up from the levels it printed in December. Interestingly, about 85% of these infection rates have recovered, which amount to about 128 million people, while death rates remain at 3.2 million people as at that same period, which implies it went up by about 8% in the last 3 months. However, in terms of vaccination, we noticed that vaccination increased significantly thanks to the AstraZeneca and a number of other vaccines. It went up from 10 million people to over 1 billion. However, it becomes worrisome because this vaccination is disproportionately administered to favor advanced economy. Looking at the top countries by vaccination, you see Israel down to United States. So on the back of the whole pandemic, we've seen a number of support from advanced economy and developing world. Fiscal and monetary policy support to GDP in a number of countries increased. We saw a decline, and we saw some maintained the support. In the US, due to the 1.9 trillion US stimulus package, support increased from 16.7 to 25%. While in Nigeria, we saw that it declined to 0.3% from 1.5%. Overall, we think that this year, economic growth will undergo a V-recovery, and this will be underpinned on the increase in vaccination, improvement in economic activities, particularly in the sectors that were badly affected by the COVID-19, particularly the aviation sector. Now to Nigeria, we observed in the last quarter that the economy exited recession thanks to the improvement in activity in the trade sector and ICT sector. ICT sector is particularly very important because despite the recession of last year, it grew by an average of 40% each quarter, and currently it's also on the uptrend. While this year we think that the economy will grow by 2.5%. On commodity prices and general inflation level, we think that it will remain elevated, and it will print the end of this month at 19.7%. The impact of the COVID-19 did not even exempt the labor market. We saw that unemployment increased significantly in the fourth quarter of the year. It went up to 33% from just about 27%. Same with underemployment that actually declined slightly, but is still way elevated. The FS market remains stifled, looking at the trajectory of the foreign reserves and backlogs of unmet FS demand. While to the condition of foreign trade statistics, it's still quite worrisome that it's largely negative because import is way above export, even despite the improvement in these two indicators in last quarter. Import increased more than the level of exports. To capital importation, it declined significantly as expected. It was as a result of over 60% deceleration in foreign portfolio investor to 5.1 billion. Foreign direct investors still remain, but it's just about 10% of the total capital importation. Now to the government fiscal deficit. We notice that the deficit will remain elevated at over 5 trillion naira, and this will be financed through sales of government property, borrowings across board, domestic and foreign borrowing. All of these sources of funding will increase this year, and particularly we notice that government will increase debt substantially, and the interesting part is that government is looking at more of domestic debt so as to mitigate exchange rate risk on fiscal obligation. We think that on assumption, most of these assumptions are quite realistic, except for the exchange rate, which we think that because the market is still under severe pressure. For the outlook on oil prices and production is quite positive because more vaccination means improvement in economic activities. Now to the general outlook, we think that as vaccination increase, we will experience improved economic growth. While some advanced countries are looking at easy monetary policy, we know that the market will continue to trade on higher inflation expectation. We also know that there's going to be divergence in improvement in the labor market. Advanced economies have begun to see improvement in employment, while in the developing countries, there's still a lag in that space. For budget deficit, we know that it could accentuate this year because government will need to refinance some of the debts incurred last year, and they will need to also continue to support some sectors of the economy that have not even recovered to their full capacity. Now to the macro and market outlook. we noted that across the fixed income space, global fixed income space, rates remain elevated from United States to Nigeria, and particularly for the 10-year yield, we observed that rate went up from 1.16% in January to 1.559%. And looking at the tenors from the short to the long end of the curve, you observe that rate went up significantly on the long end of the curve because people sold off so as to ensure ease of asset repricing. So most people are staying on short-dated instruments. On the FGM bond yield curve, we also observed similar sentiment. Rate increased substantially in the previous quarter, while in the sub-Saharan Eurobond market, we noticed that increase in yield environment in advanced countries and stronger dollar have continued to keep rates uptrend. And to the outlook for sub-Saharan markets, we know that fiscal stimulus will be sustained in a number of countries, and we know that vaccination will also improve in some selected African countries. While in terms of commodity recovery, we know that oil prices will improve, and this will be positive for the sub-Saharan market, particularly the price of the instruments. Economic data is expected to also improve, particularly GDP and employment. However, inflation is still a threat because most of these countries depend on manufactured products to sustain local consumption, and they are highly susceptible to exchange rate risk. To the fixed income markets, across the auction we've seen so far this year, rates remain elevated, particularly the bond auction across tenor of 2027, 35, and 45. While at the bond auction, we also saw similar sentiments, particularly the longest date instruments at 9.5%. The same sentiment was also seen in the secondary market. We observed that across all tenors, rates remain elevated. Now to the fundamental analysis of how the market will perform. The current sentiment in the market is actually contrary to what is expected, because particularly in July, you observe that demand will exceed supply. That should mean price will go up and rates will drop. But we are seeing otherwise, because the market is largely influenced by inflation expectation as well as the guidance of the debt management office. So we think that rates remain elevated, although sometimes in the year it could decelerate. On a granular analysis, we think that on the average, rates will print about 11.1% in June, and it will increase to about 30.1% in December. Now to the global equity space, we observe high level of bullish sentiment thanks to the US fiscal stimulus and improvement in vaccination. In the emerging market as well, we observed that the market also went up significantly across most markets, except for Argentina and Turkey. And Turkey was due to the fact that the CBN governor increased rates, and there was kind of commotion between the CBN governor and the president. This led to deceleration in the market, as well as Lira, the country's currency. At the frontier market, we observed that the sentiment was quite mixed. Nigeria and Mauritius dipped, while others improved in terms of performance. For Nigeria, the sell-off, the negative performance was due to sell-off on the back of higher yield environment. And this negative performance of 3.4% was driven by consumer goods sector, banking sector, and industrial goods sector. However, we think that this market is competitively priced compared to its comparables. Looking at the analysis in terms of price to earning multiples. Now to the outlook for the domestic equities market, we think at the very best case scenario, the market should record about 4.7% uptrend, and this will be driven by possibility of substantial monetary policy that to support the equities market. While the base case, we think that it will dip by 0.1%, and at the very bearish state, it will decline by 19.4%. Now to the broad outlook for the financial market, we think that rates will remain elevated as higher yield environment and higher inflation expectation will continue to take a toll on sentiment and market fundamental. I would think that growth in corporate earnings will also affect the market, particularly stocks in pharmaceutical space, industrial space, and the telecommunication space. While we think that investors will continue to look at alternative assets because of worsening condition of real return on investment. We also think that stimulus package will be sustained in a number of forms. For instance, we think that the CBN will sustain some of the moratorium, and the fiscal authority will continue to support in one way or the other. And the last outlook here, we're looking at the commodity market. We think that it will remain bullish as economic activities come to normalcy. This brings me to the end of the market macro review. Thank you.
Thank you very much, Matthew, for the brief analysis of the markets from a macro perspective. And if you follow Matthew very closely, you will notice that we've seen different challenges in the market so far in the year from the perspective of shaky macroeconomic fundamentals in periods where most economies are just recovering from the pandemic. We are all witnesses to what happened since 2020 when the pandemic struck, and the implication of all of these that we've seen across the globe have been weaknesses both on the fixed income side and on the equity side. And if you look at what the projection is, as Matthew mentioned, we are expecting, sort of a tepid performance on the base case in terms of equities. And on the fixed income side, we still have huge volatility, causing rising yields, for which we do not expect, a significant, positive momentum, except for those who are, very active. And even though activity also has, its own drawdowns in an environment where yields are rising. Now, this then brings us to why the alternative strategies are quite very timely, given all of what the global macroeconomic conditions are and the markets as well. So very quickly, I will just delve into the presentation proper. And we're talking about alternative investments, and this slide is just meant to give us a background of what we mean when we talk about alternative investments. And typically, any investment that deviates from the traditional asset classes that come in form of debt or equity, that come differently from the typical securities that we're used to, is what we refer to as alternative assets, maybe with the exception of cryptocurrency, which is an emerging asset class. In subsequent webinars, it's one of the topics we are going to be looking at. But for now, we are focusing on alternative investments, and we see they are investments that are non-conventional, the non-conventional asset classes, other than the debt and equity. Their returns can be higher than what you will find in the conventional asset classes, but they also have the drawback in the sense that they are less regulated, they can be less transparent, and in the real sense of it, they can be less liquid than your traditional asset classes. So if you hear names such as infrastructure, hedge funds, real estate, managed futures, which is not very common in our client, private equity, venture capital, commodities, and some others that we are going to showcase in the course of this webinar, what we are referring to are alternative assets, as the case may be. Now, one thing that, clearly distinguishes the alternative assets from, the traditional assets is the fact that they are more relatively more tangible than the traditional assets that exist in form of majorly securities. Okay, so and that's why when we talk about infrastructure, maybe you're constructing roads or constructing bridges or building some public infrastructure, these are things that you can feel, you can see them, you can touch them if you like. Private equity, investment in companies, by through what we call private sourcing of funds, basically, to invest in companies that can naturally not access the public space, like go to the exchange to issue an IPO or raise equity capital on the exchange, but these companies have potentials, and they have the possibility of growing bigger than what they have currently. Investors who believe in them can invest in such companies to take them into maturation. Venture capital are a form of private equity as well. We'll delve more into all of them in detail. Commodities these are also things that you can feel and touch. Managed futures, which basically is just a portfolio of investment in futures as investment securities, are all forms of alternative investments that you can have. Number one thing that we think we should highlight in this slide are the important characteristics of alternative investments. One of which is that returns can be less, correlated with the traditional asset classes, which is something good for your portfolio. If you run a portfolio that has investment less correlated with your equities or your bonds or your treasury bills or your bank placement and the likes, there are things that can be very good for your portfolio, especially in time of volatility. So typically they have returns that are less correlated with traditional asset classes. Secondly, we have low exposure to regulation, compared to the traditional asset classes. You can invest in your real estate without the regulator, the regulator in the capital market, for example, regulating your activities in that space. So it's less regulated. It's not that regulation is bad, regulation is good, but sometimes regulation can also be a drawback, to the performance of your fund. So that's one characteristic of it. For legal and tax considerations, in the alternative investments are also quite unique and different from your traditional asset classes. Number four, the risk and return for alternative assets, you may not easily find the data like you will find for the traditional asset classes. They are not very easy to come by in terms of data for you to analyze. So you may have to then analyze alternative investments on a case-by-case basis. Also, most alternative assets, are typically less liquid as compared to your traditional assets. So when you are investing in alternative assets, you're looking at more of a long term or a medium term, because this sort of investment cannot easily be exited, and that's what characterizes this type of investment globally. And finally, we are looking at alternative assets as having high minimum investment. So if you look at it, for you to buy into equities or fixed income, you need very little. With as little as $1,000, you're able to buy your equities or your fixed income. But with alternatives, they come very high in terms of minimum investment that can go into it. Although investment managers like Afrinvest, we're trying to from time to time bring up products that still allows you to invest something minimal for the return that an alternative investment will showcase. So very quickly, I will just take us through each of these alternative investments before we then talk through the strategies for playing them. First, when we talk about hedge funds, what's typical about hedge funds is that they have the strategy of either going short or long on securities, and also taking up leverage in order for them to optimize return on the portfolio. So by going short, we mean sometimes when they think the market is going to have a drawdown, they can sell securities to buy them back at a lower price. Or when they think that market is trending higher, they go long by buying to benefit from that upside volatility. Then leverage is more like taking up investments through borrowing for the purpose of just optimizing the returns on your portfolio. Usually leverage trading or leverage transactions are done on a tactical basis, but hedge funds are typically handled by professionals who will then ensure that all of the analysis have been done to ensure that of course whatever strategy or whatever funds you're putting your money into, you don't get to lose out. In this climate, it's not typical. I mean, as we know, there's no hedge fund in Nigeria at the moment, but just stick with us. We are, at some point, it's one of the areas we are looking at where we can possibly create a fund in the market that will be possibly the first hedge fund in the Nigerian financial market. But as it is right now, it's not something that is existing in the market as we speak. Now, to handle hedge funds, you need to be much more active with the market, because you need to study markets very closely and take advantage of opportunities such that your returns can, naturally beat any other, funds that are existing in the traditional space. And that's one thing that is typical of hedge funds, generally speaking. Your strategy for hedge funds can be equity based. It can be driven by events. It can be on a relative value basis, or some hedge fund managers may actually just be playing the macro strategy. But in a period where, or in an environment where the market is much more efficient, macro can be your strategy for your hedge funds. And as you can see, one of the characteristics is that it's aggressively managed. It will help to generate higher returns. Most investors don't like to play in this space because it's actually very risky as well. As much as the returns can be fantastic, hedge funds can also come with their very, very high risk. One of the things we try to do is to do a sampling, of most hedge funds that are, currently running in the US market as of now in 2021. So here you have is the top 15 US hedge funds as of 2021, and the strategy they have deployed. This, is as their assets under management. As you can see, the Millennium Capital Partners run the largest hedge funds in $1 billion, about $218 billion. But the strategy they deploy is multi-faced. It's not just one, particular strategy. And if you go through, you will see that the top three, have that multiple strategy. And multiple strategy for hedge funds typically means that you're doing more work. You're doing much more work than investing in the traditional assets. And that's why they can come with very high returns. And of course, the volatility in terms of drawdowns can also be much. If you take a short position, for example, and it goes against you, it could be the cost of the significant drawdown that the market will record. These are just data for us to see what we've seen so far in 2021. And typically most, in fact, almost the top 100 hedge funds are currently within the United States of America. That's where the opportunity exists largely for now, especially if you are willing to gain exposure into USD. Also, private equity is another kind of alternative investment. And like we said, when we are looking at private equity, they invest in companies that are not usually listed on the exchanges, on the public exchanges. And when they invest in this company, the intention is to, of course, it's mostly private investment, but the intention is to plug in money into companies, grow them into maturation. Then your exit strategy will typically be to, either list it on the exchange, or to, then sell to another investor, of course, at multiples of the monies that you're buying. Private equity can be very risky, and if you talk to anyone that is into private equity, or anyone that runs, or any company that runs a private equity fund, one of the typical thing you will find with private equity is you may have 10 portfolio companies. So when we say portfolio company, we're referring to companies that you're investing in. Out of 10 portfolio companies, it's possible that only 2 will deliver the return for the entire money you put into the 10 companies. So sometimes it's a game of gamble, where you're not particularly sure, even though you have run all your numbers, but these are real sector investments. They could go wrong, and if they do go well, the returns can be very superlative. So private equity means that and again, in Nigeria today, luckily we have a number of private equity firms who run funds that are invested in private equity, but most of the time they take funds from either institutions or individuals who have large capacity to invest, and that's why typically it's not usually available for individuals. But in developed climes like the US, for example, we have private equity funds that individuals can even buy into, some of whom their securities can even trade on a daily basis on an exchange. We also try to look at the return profile for PE funds, some of the PE funds, and we did a sample of about 5 of them. And if you compare it with, or 3 of them, I mean, if you compare it with S&P 500 and 10-year Treasury, you'll find out that we've seen periods where the S&P had gained significantly, but we have seen you've seen some drawdowns in terms of these funds. For instance, if you look at the year 2018, the BDC Income ETF, which is an ETF tracking a private equity fund, lost about 15.4%, whereas when you consider what S&P 500 did, it was much more than that, and some private equity funds were still able to do better than that. But the most recent 2020, for example, which was a very good year for traditional asset classes, we saw that the S&P did quite well. S&P did quite well, returning about 16.3% as against most private equity fund that you will find around. Now, to the next traditional asset class, alternative asset class is venture capital. It's very close to what a private equity firm or if a private equity fund would do. The difference basically is that for venture capital, they are more, the scale of portfolio of companies they are looking at could be much smaller because the potentials for companies that VCs will invest in may be much lesser than those of private equity. But technically, if you have to rank them in terms of risk, it is riskier to invest in VCs than to invest in private equity in terms of risk. And so the return can be much greater than that of private equity, as well, as we're going to show. But typically they are, typically within the same line. So it's also typical that most investors in venture capital could be angel investors, family members, those who are willing to take a risk on a particular venture. They might be small scale businesses that someone is trying to nurture into maturity. Now, real estate is something that most of us are very common. It's very common in our climate as well, and is one area that most investors will note today that it's a very good alternative vehicle for deploying your funds when you're considering alternative investment. The nature of real estate is such that it's very illiquid as well, and for a country like Nigeria, where you have a lot of deficit in terms of housing, and deficit in terms of infrastructure, it provides a very huge opportunity, to take advantage of, of the market. The returns can be very interesting. Sometimes the ROI, or as you would say, the IRR for most real estate investment, can be as high as over 50%, within the space of, 1 year, mostly, if it's a residential real estate. But one area is, the commercial real estate, where, you are typically engaged in the construction of a more, of course, because of our development phase in Africa generally, and Nigeria in particular. Now, one of the things that we have studied in real estate is doing real estate for rental yield may not be something that is optimal for most investors. So you may want to be considering investment in real estate for a buy and sell. So when we say buy and sell, it could be you're investing in an already built, property where you will, then sell or upsell to, another buyer at a later time. Now, because of, the location, which is always a major factor in real estate, typically, if you talk about real estate in Nigeria, there are three prime locations we often talk about: Lagos, where we sit, Abuja, and Port Harcourt. These are places where the opportunities exist. But in other climes, like in the United States, we have derivatives of real estate where you have some mortgage-backed securities. These are systems that create enough credit system around housing, which then allows people to buy into a lot of properties. In our climate as well, mortgages are not quite common. It's still in its developmental phase in Nigeria. But we have REITs. REIT is real estate investment trust, where you can securitize real estate properties. And we have a couple of them. But the challenge here is that they are not also as liquid. So our most viable option for investing in real estate is still to go through the hassle of investing directly to then off-sell. And if you notice, if you've been following us from time to time, we always come up with opportunities, special products within the real estate space that investors can take advantage of. In this case, what we are doing essentially is to take on the risk and then invite investors that want to play in that risk to invest at a much more smaller unit than when you're going on your own. Then commodities are quite common, from gold, which we all know, to other commodities, either oil, and there are a lot of derivatives around energy, or you're trading metals, or you're trading agricultural products. There are direct opportunities to invest through them, and there are opportunities to trade them. You just buy and sell. And the buying and selling also moves with, of course, the market fundamentals. Now, the derivatives that have been created around the commodities, come either in form of futures contract. You'll have heard that most of the time when Nigeria sells its oil, most of the time we're selling, in the futures market, and not necessarily oil prices. You don't get to see the impact almost immediately until, of course, you then see, maybe in the next 3 months when you now start seeing the impact of events that have happened in the past 3 months. So commodities are also very good, but one drawback to commodities is that they can be very volatile, very and highly very volatile. One way to invest in commodities are still through ETFs. One of the ones that we like to feature is gold, for example. Gold, because it tends to also move with the traditional asset classes most of the time. If you see gold prices trending higher, it means that the market is on a risk-off mode. Maybe equities are down. The tendency is that people will tend to move to safe haven assets like gold, which that opportunity is what it offers. But for commodities like oil, they can be quite volatile, and maybe this is not a good time to start trading oil. And like I said, we tend to play all of these by buying into some ETFs that exist, not here in Nigeria per se, but within particularly the US market. Then managed futures, as I mentioned, we don't have it. It's not common in this climate. It's when professionals actually buy into a portfolio of futures for the purpose of managing them aggressively to deliver superior returns. Typically, you will find two main strategies, the market neutral strategy or the trend following strategy. When you're market neutral, you're just trying to play on the volatility. You want to ensure that you're not, getting your fingers burnt. And so you're basically just looking at the movements in the macroeconomic fundamentals and how they affect the market. As against when you are doing trend following, trend following is where you go short or long. Short when you know that market is, going to have a drawdown, you could short on your securities to buy back at a much more lower price at a later time. Or you could go long if you're sure that market is trending higher. Like I said, this is a type of alternative that is not common in our client. Maybe at some point we can float a fund that will be targeting my futures, but that will not be until when we have enough derivatives products in the market. Okay, for infrastructure, this is one area where we think there's a lot of opportunities. One of the things that we think we can do here is that even though they come, in terms of scale, they can be very high in terms of capital intensiveness. But because we are investment managers, we know that we can always put products together that then enable investors to buy into them. Nigeria's infrastructure deficit is huge, and is one area we think that we can begin to, play a lot of role. We have quite a number, very few of them, I would say, infrastructure funds that are, springing up in the market. And these are ways that investors can also diversify away from the traditional assets. The other alternatives that I'd like to mention here are, antiquities, collectibles like artworks. These are priceless works of art that some people can use to, safeguard or to secure or store value, for a later use. Most of the time, this can be very risky as well. If you are not very used to how the market is, you may pay too much for a piece, and you may not be able to, match the value at a later time. Artworks are very good in that they help you to also store value, and they can be very good for inflation hedge. About like I mentioned earlier, we won't really classify cryptocurrency as an alternative investment. We think that it will rank more like a currency. That's why in a class of its own, it's a cryptocurrency, which is an asset class on its own. We hope to dwell on this at a later time, generally speaking. So in terms of strategy, if you look at traditional assets versus alternative assets, and you check their returns over time, the tendency is that on a risk and return basis, you're likely to find the high return alternatives, so also having the higher risk. And if you look at it, if you look at this chart that is showing on the screen, you will see that most alternatives are within the region of higher risk and higher return, because their risks are actually come with moderate risk, moderate return, and sometimes superlative return, that comes once in a while. Now, this is also a chart we adopted from JP Morgan, and this is just showing you the correlation matrix between the traditional asset class, or amongst the traditional asset classes and the alternatives. And you will notice that the ones that have the lower correlations are typically better than the other ones with higher correlation, if you have to put them in a mix of portfolios. Again, this is like a 3-year returns for alternatives between 2018, 2019, and 2020. As you can see, hedge funds returned about 12% in 2020. Real estate did 18% in that same year. Private equity, 28%. Infrastructure, 22%. Gold was 16%. Or S&P 500 did 29%. Clearly, 2020 was a very good year for S&P. But if you look at 2019 as well, you will see that most of the assets actually underperformed both traditional and alternatives in 2019. Again, we're just trying to show what sort of returns we can see when we invest in alternatives. So generally speaking, our strategy for playing alternatives is, first of all, you must understand the dynamic or the dynamics of each of the asset classes you're trying to play in before you invest in them. You must understand the fact that alternatives can be very risky, but the returns can be very good as well. So you must be ready to play with the risk and the return potential that these alternative investments could offer. Again, in terms of risk return profile, it's safer for you to pick the alternative assets that you're comfortable with the risk. I mean, from what we were talking about, if you look at VCs and Ps, they come with a much more higher risk. But for funds that are tracking private equity, one of the ways they're able to do this is that they diversify even within the asset class. So you can have a portfolio of companies of up to 10, like I said, and it might just be 2 that will actually offer you the return that will cover for the entire portfolio. So diversification is very key, even when you are investing within alternative assets. Again, you must also consider how government policies can affect your investment in the alternative asset class that you have chosen. Again, you can always consistently scan the market for new opportunities because they always exist. And be rest assured that we always bring the opportunities to you once we spot them, as we have always done. We've showcased a number of opportunities in the alternative space, which we always hint you with. Very quickly, I will just rehash again our investment strategy, which we discussed during the Q1 session, just tracking how we're doing and how alternative investment, which we focused on this quarter, can help you to actually take advantage of this investment strategy. One of the things we have said is that it is certain now that we have so much uncertainties globally, both in terms of macro and market. So diversification is key. And the reason for diversification is so that you are not concentrating your risk. So again, even within traditional asset classes, we preach diversification. If you pick one asset class within the traditional space, say equities, we still preach diversification across sectors in equities. And if it's fixed income, we preach diversification across maturities and across markets so that you can always ensure that you're safe. So diversification is very key and still a strategy that we are preaching for Q2 2021. Active trading is one area we think you can take advantage of opportunities. However, you must be sure in the market so far in 2021, it seems like taking a strategic position is more of a winning strategy than activity. So you have to be sure, you have to learn the art of trading if you must be active. Otherwise, it's better for you to remain strategic, which is our number 5 item in our strategic, in our strategy that we are looking at. Market timing, it cannot be overemphasized. If you're able to time the market accurately, it's better for you. Tactical positioning also works when you're sure of the opportunities you're seeking to take. And of course, safe haven assets are also things that investors should consider in a period of uncertainties like this. This is a table we also showed you in Q1 with a bit of updates on, if you look at the different asset classes, what sort of outlook we have and what strategy we think you should use to play each of them. We're going to be circulating our slides at the end of this webinar so that you can go through them in detail because of our time. But in terms of opportunities, we think that the US Treasuries still offer very good opportunities for investors. Between our last call and now, you can see what return we've seen. There are drawbacks in the sense that the US equity can be quite volatile. And if you are trading it, you have to be extremely careful and more of a strategic position than a tactical position in US Treasury. In the sub-Saharan African space, Eurobonds, we think that there are opportunities that investors also do not want to miss. One of the things we highlighted in our last call, we recommended Nigeria 2038 and 47, and they still present that opportunity even now. Ghana 2035, and of course, CEPA 2026 were also securities that we recommended at the last call. In terms of domestic market, it's becoming, extremely volatile to play in the Nigerian market. So far in the year, it's been quite volatile. So we think that, maybe trading is not also a strategy to adopt for Nigerian fixed income, particularly bonds. More of a strategic position, especially now that we've seen higher yields, is what we preach for investors to take. In terms of equities, we've seen some improvements so far. In Q1, we saw, up until April ending, we saw the improvement that, most of the equities were able to showcase, even though we have also seen some significant drawbacks, more like market is correcting at this point in time. So we think that caution is still what we preach if you must be trading equities, either in the US or in Nigeria. We still have our universe of equities, which we recommend, as you can see on the screen. I will be sharing the slides for everyone that registered for this webinar, so that you can, again, familiarize yourself with them. Our outlook on equity is not great for 2021, but we still think that for investors who are strategic, you can hold on these securities we have for strategic positioning. Gold, as we see, is still a safe haven asset that we think investors should continue to take advantage of. Oil is very volatile, and investors should exercise caution in trading them. Cryptocurrency is one asset class that we love, but because of regulation, there is little play in it. But just for you to see some of the benefits or some of the returns that you will have recorded between our last call and today. Finally, I have real estate and some of the selections that will be from a securities perspective. Vanguard Real Estate Index and iShares US REITs are just some ways through which you can invest in the real estate market. So this slide, the last slide here, is showing us some of the recommendations we did and how they have performed between the last call that we had and this time. As you can see, our equities haven't performed so well, with the exception of Seplat and Okomu, who have done, reasonably well. In terms of US Treasuries, we've seen marginal gains in return on what we recommended. Same for the Eurobonds market, we've seen marginal returns on what we recommended. And finally, on domestic bonds, we haven't seen so much improvement in terms of returns as well. But cryptocurrency definitely have done well. Because of time, I'm going to stop here. We'll take questions shortly after Folani takes us through the portfolio in about 2 minutes. Thank you very much. And Folani, over to you.
Yes. Good afternoon, everybody. Folani Adediji speaking. So I'm portfolio manager, Afrinvest Asset Management. Can you? Yes. I'll be taking us through our in-house regulated portfolios. Firstly, I'll be starting with Plutus. Plutus is a mutual fund, money market mutual fund that is skewed towards investing in money market securities like fixed deposit, treasury bills, and cash. It has a very low minimum entry of about 5,000 Naira. So for the retail end, it's a very good place to start and invest your money if you are risk averse. Then I'll take us through our Afrinvest Dollar Fund. Our Dollar Fund is a dollar-denominated open-ended mutual fund, which is strictly invested in dollar-denominated assets. The assets cuts across Nigerian sovereign Euro bonds, corporate Euro bonds, and also cash. It's particularly good for investors who are also risk-averse but want to preserve their capital, especially against the devaluation of Naira. I'll take us through our NIDF fund. It's a fixed income mutual fund that they mostly invested in federal government bonds and state bonds, with allocation of about 80% into federal government bonds and 15% in money market instruments and cash. It's also good it has a very low entry point. good for investors who are seeking attractive returns. And on this particular mutual fund, we pay investors on a semi-annual basis. And I'll take us through our AIF fund. Our AIF fund is Afrinvest Equity Fund. It's a mutual fund that invests mostly in Nigerian listed companies on the Nigerian Stock Exchange with sound fundamentals and good track record. It's also good for diversification. It has a very minimum entry point for retail investors at 50,000 Naira and with an holding period of about 180 days. It's good for investors that want to have a good exposure into Nigerian equities and people who are also investors who are also risk lovers. I would also take us through other discretionary AIP income portfolio, which is dominated both in Naira and dollars. This particular portfolio gives more so guarantees capital and interest in both USD and Naira. It's for investors who are risk averse and also would want to protect their capital. The minimum entry for this fund, this particular fund on our AIP Naira is 500,000, cuts across 30 days to 365 days tenure. This the underlying assets for this for our AIP Naira and dollar is mostly traditional assets and also alternatives, which we have highlighted during these calls. Alternatives like real estate and other alternatives as we see that they fit into this particular portfolio. On our dollar side, we have our AIP dollar, which is also similar to the Naira, with a minimum investment of about $25,000. This also cuts across 30 to 365 days investment. And here is a snapshot of the kinds of return you get when you invest in an AIP dollar or AIP Naira portfolio, cuts across from 30 days down to 364 days. We also have our discretionary portfolio management services. This strictly for HNI clients and institutional investors with net assets, with net worth of about 500 million Naira. So here we will directly manage the portfolio for these classes of clients and also model a return that fits the profile of the client. So thank you very much for attending our webinar. I'll be handing over to Victoria.
All right.
Yeah, thank you very much. A very insightful session, if you ask me. Our Q&A box is already buzzing with a lot of questions. We might not be able to answer all questions, but we'll answer some here and we'll also get back to you with your answers. If you have more questions and you have not already sent a question, you can always send it to us at aml@afrinvest.com. That's our email address, and we'll do our best to answer all the questions. So quickly to some of the questions. Wow, there's quite a lot. Okay, starting with the first question here. What do you think was responsible for the sudden increase in the Treasury bill rates last year?
All right, I think we can answer the question one after the other as briefly as we can. So if you notice, last year was a very good year for government in terms of cost of borrowing, even though our own analysis is that last year really didn't support a lower yield environment. But the major factor that drove that was because late 2019, we saw this segregation between the Treasury bills and OMO market. And that actually impacted on, those, the activities of most investors. Because what we then saw was that investors who couldn't buy into OMO then rushed into buying bonds and the likes, and that led into a lot of compression in yield, coupled with the fact that we saw that the DMO was kind of tilted more towards, lower cost of borrowing throughout last year. But this year, you've seen that we have increased budget. Government needs to spend more, both on recurrent and capital expenditure. We've also seen a situation where the government seems not to want to pull the part of ways and means as a source of funding its budget deficits. And so government is trying to borrow as much as possible. Now, this is one of the reasons why we think that investors are, asking for higher yields, and the DMO is also shifting ground. And that's why we've seen it at this level. The final point I'd like to make on that is that we noticed that it was sometime in January that we saw the central bank announced a 500 basis point increase in OMO rate on the longest tenor. That factor also impacted on how investors were perceiving Treasury bills rates. And as we saw at every auction since then, we've always seen rates inching up. These are some of the reasons that we can provide at this time that led to that increase. But we think at some point it's going to halt, especially if OMO rate doesn't go past 10.1 that it is currently. We think Treasury bills rate may not go higher than 10%.
Okay, thank you very much. As I said earlier, I will not be able to answer all questions. So I'll be taking the second and final question. If I did not read out your question, we are so sorry about that. Please do well to send us email at aaml@afrinvest.com, and we'll promise to get back to you with answers. And for those asking about these slides and presentation, we will definitely be sending it to all participants. So no need to worry, you're going to get this slide. So for the final question, considering the challenges that arise with real estate investment in Nigeria, how can investors mitigate the prevalent risks associated with the sector while aiming to maximize returns?
Thank you very much. I think that's a very interesting question from the perspective of real estate as an alternative investment. And from our own few studies that we've done on real estate, definitely is one area that investors don't want to overlook. And again, there are inherent risks. So I think the risks are kind of multifaceted when we are talking about real estate. One of the risks you want to consider is construction risk. If you are building from ground up, and construction risk, is such that, first you have to put in all the money, you have to ensure that, the contractors get the job done, and as at when due, you have to ensure that you make allowance for increase in building materials, the prices of building materials, again, because that is characteristic of what we see when we talk about real estate, because of high rate of inflation, exchange rate volatility, and the likes. So in terms of construction risk, it is enormous. Then you move to what we call liquidity risk. Now, if you build and you don't have off-takers, then you're stuck, right? So which then means that when you're building, you have to ensure that you're building the type, or you're investing in the segment of real estate where you have high demand. And from what we know now, we have demand in the highly residential real estate, where, because again, the deficit in terms of housing in Nigeria, most people are either buying to tie down, or to invest for the long term, or some are either buying to live in, or some are either buying to resell. So again, a lot of activities are going on in terms of, residential real estate. So that's one area we will recommend you can mitigate the risk of liquidity. The risk of construction, like I mentioned earlier, you may have little or nothing to do with that in terms of mitigation. All you just have to do is to build in your allowance for price increases, or best case, you can buy your materials upfront if you know exactly what you need. Because if it's going to take you 10 months to construct, and you want to buy as at when you get to different milestones, it is not what you have projected that you will be paying. So if you have enough place to store all the materials, sometimes you want to buy from the first month of building if there are no materials that are susceptible to decay when you store them. So again, all the risks are they are much in real estate when it comes to real estate investment. But one way you can also mitigate the risk is to just subscribe to frequent opportunities that come up. And as I said earlier, if you know us, you will notice that there are sometimes we will have appraised the risks that are inherent in a particular real estate investment, and then we'll package it to you and showcase it to you in form of products that you can then invest in. Then your risk is taken care of, because we will have done all the analysis of the risk profile, and then we are able to come to you at a guaranteed return, which is now also better than what you will get from the traditional asset classes. So that's one way you can actually mitigate. And I can assure you that from time to time, we'll bring you deals that you can actually invest in as a way of diversifying away from the traditional asset classes. Thank you.
Okay, thank you. That is, this is as much as we can go. We are sorry if we did not take your questions. A lot of questions came in, which means that a lot of participants were, listening to what we had to say. So please, if you have questions, I already dropped the mail in the chat box, aml@afrinvest.com. Do well to send your questions, and we are going to be responding to all of your questions. So until we meet in the next edition of our webinar, we wish you the best in your investment, and Eid Mubarak to all our Muslim participants, and happy holidays as we go into the week. Thank you very much.
Thank you.